Welcome to Module 2, Section 6, where we will try to answer the question, what are financial market indexes?
When we look at market indexes, in order to gauge what's happening, not only in the US, but around the world, the first thing we need to consider is, do we use the word indexes or indices? In the US, indexes and indices are usually used interchangeably. It's pretty common during the course of a conversation. If I'm talking about an index and more than one index, I may say indexes or indices in the same sentence. However, outside of the US, indices is the preferred word. Indices is actually correct, but we've used indexes so often in American English that it's really become accepted as a way of saying this word. So we really have two forms of the plural word. Both indexes and indices are considered correct, especially when you're talking inside the US. I usually use the word indexes myself. What are some definitions that we need to go through really quick to help us understand about market indexes? First of all, we need to look at the different types of charts. Some indexes we follow on an intraday basis. This is while the market is open, and it may be a 1-minute chart, a 10-minute chart, a 60-minute chart. Personally, I end up following 10-minute charts most of the time. We also have daily charts, where each bar is a day. If it's a bar chart or a candlestick chart, that chart will have an open, a high, a low, and a close. Another thing that I use are called end-of-day charts, or EOD. These typically will calculate a few hours after the market closes, but just gives us a closing value. Some of these can be very helpful when we're comparing different markets against the stock market. Some indexes that I look at are based on an ETF. The idea is that an ETF has a one-to-one relationship between an index and itself. Typically, they trade like a share of stock, so we have an open, high, low, and close, just like with a bar chart. The one additional feature of an ETF is that we have volume, and that can give us some insight as to what is happening. And we'll also look at average volume over a period of time. Let's get some background as it applies to indexes that we use in the stock market. Until the late 1800s, the stock market's current condition was known only by what stocks an investor owned. There wasn't anything called an index. If you had a portfolio of stocks, you might look them over and say, these 6 stocks are up, these 4 stocks are down. I do some quick calculations, and overall, I'm showing a profit or I'm showing a loss. In the late 1880s, Charles Dow created a hypothetical index of the most important companies at that time. They were first railroad stocks, then it morphed into industrial stocks and was the precursor to the Dow Jones Industrial Average that we use today, and it's easily the most cited index out there. Today, there are over 5,000 indexes just for the U.S. markets. These can also include U.S. indexes that are looking at other countries or other sectors, but we have so many to choose from, it's really hard to know which ones are useful and which ones are not. So which ones are best? Market participants usually find an index that they like, and that often becomes the index of focus. I let the market determine which indexes I follow. If it becomes popular, then I start following that as well. Because I have a method that's a little bit different than anybody else, which is called the consensus approach that's implemented by the SPX investing program. I use a lot of different indexes to see what are other people looking at, and they are looking at things that will help them make decisions. So I try to make the same decisions that the real smart money is making. Let's look at some of the different indexes. Indexes can represent a broad or narrow segment of the financial markets. You can have indexes that measure all of the stocks in existence. You have other indexes that measure all of the different markets around the world. You have other indexes that look at a real narrow section of the market, and I'll give you some examples of each one of those. Calculations are made based on the stock values that make up an index. That only makes sense. If you want to know how an index is performing, you need to look at the stocks that make up that index. Most indexes are weighted according to the size of the company. So a big company, such as Apple, they'll have a lot more weight than some smaller company that maybe you've never heard of before. Different weighting methodologies are used. There are lots of different companies out there, and they've created their own indexes, and they have their own method for calculating these indexes. Some are price weighted. This would include the Dow. This is the most cited index there is. I don't really like the Dow to get an idea of what is happening in the market because it's only made up of 30 stocks. And that's not necessarily a good representation of all of the companies that are traded in the US. But it's interesting to watch the Dow at times. You might have 29 out of the 30 stocks up, but a really big stock like Apple or Microsoft may be having a bad day, and their influence on how the index is calculated is so much that the Dow may actually be down. So it can produce a real skewing effect. There are other value-weighted indexes, and this is the S&P 500. Look at this as the number of shares. So those companies that have the most number of shares, they carry the most amount of weight in the index. Companies that are a little bit smaller, yet still meet the criteria for being included in the S&P 500, they don't carry as much weight in the calculation. And then we have unweighted indexes, where you just take however many stocks there are in the index, add up all those prices, and that is the value of the index right there. There are unweighted indexes that I do follow and that you can follow as well. What are some of the most popular indexes in the US? Some of the stock market indexes that we look at are the Dow Jones Industrial Average. A lot of times when I'm talking about this in videos or in blog posts, I'll just refer to it as the DJX. There's also an ETF that trades with the Dow, and those are called the diamonds. And the symbol is DIA. And there are also mutual funds that are based on the Dow. The Dow is made up of 30 stocks. So again, that's why I really don't like it as a representation of what's happening. But if you talk to a lot of people, they'll say, oh, the market's up 1,000 points, the market's down 1,000 points. They're talking about the Dow. The financial media loves to quote the Dow and base everything around the Dow. A lot of people like to base things around the Dow. I look at the S&P 500 to tell me more of what's going on. I think that's a better representation of what's really happening. Then we have the S&P 500 index, and I often call this SPX. In fact, the program that I referred to earlier is the SPX investing program. That's where the name comes from. There's also an ETF that trades with the S&P 500, and this is called the SPY, or we may refer to it as SPIDERS. That's an acronym. Yet the symbol is SPY, and there are lots of mutual funds out there that are based on the S&P 500. There are currently 505 stocks that make up the S&P 500. At one time, there were 496. Sometimes it gets a little bit over 500, sometimes a little under 500. Standard & Poor's just came up with the name of S&P 500, and it may not be exactly 500, but yet that's what we call it anyway. There's also a thing called the NASDAQ Composite. Those are all of the stocks that trade on the NASDAQ. I follow that, but I don't follow it as closely as another NASDAQ index that I do follow. Currently, there are 2,667 stocks, and this number will change depending on what source you cite. This is the number I was able to find that seems to be the most recent. This number will change over time as stocks are taken off, as they're acquired by other companies, as new ones are added. The index that I like to follow that's attached to the NASDAQ is the NASDAQ 100. A lot of times I'll just refer to this as the NDX. There is an ETF that's very popular. It's not as popular as the SPY. The ETF that is attached to the NASDAQ 100 are the QQQs. There are also mutual funds. Currently, there are 102 stocks that make up the NASDAQ 100. Again, just like the S&P 500, will drop a little bit below 100 at times, a little bit above at other times, but it's right around 100. There are also bond market indexes that we look at, and I look at a lot of different charts for bonds. We don't trade the bond market in the SPX investing program, but we watch the bond market very closely. There's the Bloomberg Barclays U.S. Aggregate Bond Index ETF, and I have a chart of that I'll show you a little later on. There are other bond indexes that I do look at, but I just wanted to mention this one here. Investors don't directly invest in an index. You can't just walk in and say, give me the Dow. You have to do that through an ETF or through a mutual fund. They use indexes for a broad-based benchmark and also for developing different ETFs as well as mutual funds. Other popular indexes that we may look at are small cap indexes. These tend to be smaller companies that are rising over a period of time in popularity. Even the really big companies at one time started as small companies, and then as they grow, they're included in different indexes. The inverse is also true. You have companies that were really, really big. Think of Enron. As things started to fall apart in that company, they went from the large cap index down to the mid caps, then the small caps, and then to the no cap index. One that was very popular for a long time was the Russell 2000. It doesn't seem to be as popular anymore, and I've switched to looking at a little different index, which is the S&P 600. We look at small cap stocks because in healthy environments, people are willing to take on more risk. They're kind of bored with the average everyday well-known name stocks, so they want to be a little adventurous and go out and find something new. This is generally considered to be more risky, but when this is happening and small caps are leading the other indexes, this can show us that we're in a pretty healthy environment. The inverse of that is also true. When small caps are lagging, look for things to carry over eventually into the other indexes. There's also the mid caps, and the same can be true for that. These are medium-sized companies. They're beyond the small cap arena, but they're not big enough for the big cap arena, at least yet. They're more middle of the road. And so we look at those stocks, and in a good, healthy environment, those stocks will also be climbing and generally outperforming other indexes. In an unhealthy environment, they will be underperforming the other indexes. The index that I look at most of the time is the S&P 400. Some other markets that I look at, and I talk about this more in depth in a video called Intermarket Analysis, where we don't just look at the stock market. We look at lots of different markets that can give us clues as to what may happen in the stock market. This can be the US dollar index, and there are two indexes out there. The one that I follow is the USD. It's been around a little bit longer. It's what I'm used to using. We also look at gold. I look at the ETF for gold, GLD. Then I can have volume analysis that I can also perform. I also look at an oil index, and this is WTIC. There's also a thing called the FANG index, and I purposely spelled it incorrectly here. I wanted to include the two A's. This is Facebook, Amazon, Apple, Netflix, Google, which is really called Alphabet, but we know it as Google. And they've created an index just of those stocks because they're very popular. And a lot of people like to invest in them on a longer term basis and trade those stocks on a shorter term basis. Then we have another thing called the volatility index. I usually refer to this as the fear gauge. When this index is going up, there's a lot of fear. When this index is going down, fear is subsiding. If it gets really low, it means fear is pretty much non-existent, and we're in a real complacent environment at that point. There's also a thing called the CRB index, the Commodity Research Bureau. This measures different commodities. We look at this to see, is inflation starting to become a problem because the different products out there, metals, coffee, sugar, and those types of products, when they start to increase in value, eventually that will spill over into the prices that we have to pay when we go to the supermarket or when we fill the tank with gas. Now we'll talk a little bit about index calculations and the different uses. Each index is calculated differently, and some have their reasons for calculating them a certain way. Some of those reasons you may agree with, or you may not agree with them. I don't really have an opinion. I try to focus on those indexes that have become the most popular, and then I watch those. Some indexes are calculated in a very simple manner, and others are really complex. I'm not going to get into all the intricacies of how these things are actually calculated. I just want to know if it's popular, I'm going to look at it. If it's not popular, I'll look at it sometimes or maybe even ignore it altogether. The index creator will specify the method and then their rationale for using that particular method. They have their reasons. They put those reasons into how the index is calculated. Investors and money managers use indexes to base performance. You hear that a lot. A mutual fund or even an ETF will be compared to an index. Did we beat the market? If the S&P 500 had a return of 9%, but a mutual fund or ETF had a return of 12%, it outperformed the market. The inverse is also true. They can underperform the market as well. I have a whole section where I talk about actively managed funds and actively managed ETFs versus index mutual funds and ETFs. Which one is better? Some investors create their own index. You can do this. You can come up with your own methodology and create an index. You can base it on a portfolio that you have. You can look at the Smith index and say, wow, we went up 4 points today, or we dropped 10 points today, or we're up 100 points this year. If you're really into calculations and numbers and figuring out what you want to do, feel free. Break out a spreadsheet and have some fun. I don't do that myself. I know a lot of people that do create their own indexes. You use this to see the value of your overall portfolio or to gain specific insight. Maybe you have a real interest in a certain area of the market and you haven't found an index that you really like, so you might create your own. Let's talk about the different types of indexes. There are narrow indexes that just look at a small area of the market. This can include the sectors. The S&P 500 is broken down into 11 different sectors. One of those sectors is the tech sector. And here's the symbol $SPT. I look at that every day. We look at these different sectors, and that helps to see what's happening in the market as investors shift from one sector to another sector. During different times of the business cycle, there will be different sectors that are popular. When investors start to see warning signs, they'll move from one sector into another sector, and we can watch that, and that gives us some really good insight at times. You also have seasonality factors that can play into this. There are some stocks that trade better during different times of the year, and other stocks that trade worse. There are micro-sector indexes as well. This can include something such as the SOX index. This is the Philadelphia Semiconductor Index. It's gained a lot in popularity, and if you're really into semiconductors, you probably follow this a lot. There are also ETFs attached to this index, as well as options, and a lot of different strategies that you can implement. There are bond indexes, which are usually based on maturity. I don't have a lot of bond charts here beyond just the aggregate chart that I'm going to show you, but I look at different yield charts, I look at bond price charts, I look at US bonds, I look at corporate bonds, I look at world bonds, so you can really go crazy with a lot of these different indexes. You can also have indexes based on geographic segment. This could be West Coast stocks or East Coast stocks or only US-based companies. You can also look at different countries as well, such as the emerging markets. That's really popular with a lot of investors. The ETF that has a lot of volume attached to it is the EEM, and this includes different companies in Taiwan, China, Japan, Brazil, India, and the list goes on and on and on. Just Google this and see all of the different countries that are represented by this ETF, and it changes over a period of time as things change in the world. There are different world indexes that we can look at to get a really big picture of what's going on. One that I follow is the All Country World Index. There are also different indexes for countries, such as the DAX. That's the German index. One that I do show a chart of is the Japanese index called the Nikkei. So how do we use this for analysis? For members that belong to the program that I offer, the SPX Investing Program posts a weekly video that analyzes not only US indexes, but world indexes as well. I don't post those on YouTube. Those are available just to the members. All indexes are viewed each day, but typically reported on each week. So if nothing's really happening, I don't talk about it. But if necessary, significant changes are reported in the daily videos that I do. I have videos that I do every day, other videos that I do every week. And as something happens, I will report on that. Let's go in and look at some charts of these different indexes. And one of the things that you'll notice is a lot of these charts end up looking very similar to each other. That's why I don't have 50 index charts that pretty much show me the same thing. If I'm seeing something new or insightful, that's great. If I'm just seeing the same thing over and over and over, it's wasting my time and I want to move on and do something else. This is the Dow. It's the most popular chart. What I have here is a bar chart with an open, high, low, close. It's a little hard to see. This just gives us an idea of how things move over a period of time. If you're interested in learning more about different indicators that you can use, which are calculations that you can use with these charts, please look for one of the other videos that I have posted. Then we have the S&P 500. This is the chart that I look at most of the time. I think it's a better representation. And you'll see it looks a lot like the Dow. The NASDAQ looks a little bit different, but they look kind of alike for the most part. Here's the NASDAQ itself. I don't look at this one all that much. I keep an eye on the NASDAQ, and if something really weird is happening, I may bring up a chart and look to see what's going on. This is the one that I look at every day. This is the NASDAQ 100 or NDX. These are the top 100 stocks in the NASDAQ. Here is the bond index that I talked about earlier. It's the Bloomberg Barclays Aggregate Bond ETF. I also talked about how the S&P is broken down into 11 different sectors. This is just the technology sector. Here is an equal weight index. The S&P 500 is a weighted index. Some people don't think that's fair. That's not a real good representation of what's going on. So they may decide to look at the equal weight index, where you take all of 505 stocks together and that gives you the current value. What we can do is a bit of analysis. This is the S&P 500 with the S&P equal weight index on top of it. The S&P is in red, where the equal weight index is in black. One thing that we can see from this that we find helpful, when the black goes above the red, that means all stocks in the S&P 500 are participating in that particular move. When we see the red going above the black, that means that there are just a select few stocks that are really leading the way. In a really healthy environment, we want to see the black line above the red line. When things get a little dicey or we're starting to see concerns is when the red line is above the black line. If you look all the way over to the right, you'll see that we are in that environment right now. A lot of the really big tech stocks are really leading the way, but we're seeing a real shift right now. As interest rates start to go up, tech stocks are starting to go down. Another index that I talked about is the SOX index. These are the semiconductors. There's also a very popular index that I don't use all that much. This is the NYSE composite. These are all of the stocks that trade on the New York Stock Exchange. This would be really good if the New York Stock Exchange was the only game in town, but we have the American Stock Exchange. We also have the NASDAQ. I don't use this one as much. There are calculations that I do perform based on this index. Then we have the ETF for emerging markets. The symbol is EEM. This has become very popular over the last few years. People see trouble inside the US, or they see a real opportunity outside of the US, and this is a way for them to be able to participate in other markets where there's great liquidity, because you have really high volume, and an opportunity to get a more diversified exposure in the market. This is the all-country world index. What is the world doing right now? This can be helpful at times. However, the US is still the biggest player when it comes to stock markets. The US carries a lot of weight in this index, so we might as well just look at an S&P index as well. I prefer to look at individual countries. Here's the DAX, which is the index in Germany. And I follow that pretty closely because Germany is the biggest economy in the EU. There are also other EU indexes that I follow. Here's the Nikkei, which is the index for Japan. Consists of 225 stocks. I just get the end of day version for this. By the time the US market opens, Japan has been closed for quite a while. And then the Japanese market will open not long after the US market closes. This is the small cap index, and for a long time I looked at the Russell 2000, but now I've switched over and I focus more on the small cap index put out by Standard & Poor's. Here's the mid cap index, which is also put out by Standard & Poor's. We can do some comparisons. We can use something such as the S&P 500. We can put the mid cap and the small cap on top of this to give us kind of a gauge as to what is happening. This is the Wilshire 5000. This index looks to measure all of the stocks that are in the US, so we get a really broad picture. And for a lot of investors, this is their favorite. Next, we have a chart of oil. This is also an end-of-day chart. Oil can get really crazy at times. In fact, it even went negative there for a while. Then, when I talked about inflation, we look at the CRB index. If the CRB index is really starting to shoot up, that may mean that inflation is becoming more and more of an issue. And at the time I record this, that's kind of what's happening. Interest rates are going up. The CRB is really going up. The only problem is gold is not going up right now. In a high inflationary environment, you would see precious metals going up, specifically gold. But we really don't see that happening right now. There's another index. This is the fear gauge. And so what I did is on the top is the S&P 500, and on the bottom is the VIX, the volatility index. The rule of thumb, and you hear this catchy little tune in any class that you go to or books that you read, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. Okay, fine. But what is high and what is low? And that is kind of changing right now. We're seeing not a real strong trending market at the time I record this. If you look way over on the right-hand side, fear is still pretty high. It's not as high as it could go, but there's a lot of hedging going on out there. A lot of the big market participants are a little bit fearful right now. It has been falling, and usually when we have an up day in the market, the VIX will fall. When we have a down day, the VIX will go up. It changes all the time, and this has become so popular, you can actually trade the VIX. You'll find that with the financial markets. Anything that moves, hey, let's bet on it. Just like races, dog races, horse races, turtle races. Another area that I wanted to cover before I conclude this video, I just wanted to show you what I look at. Some of you may find this useful. Some of you might have other tools that you use. Although the stock market is open during the day in the US, the futures trade pretty much 24/6. They stop trading Friday afternoon, and then they pick up again, usually Sunday evening or later in almost to nighttime. They're trading all the time. This is often called the extended market or the overnight market. I watch these all the time just to get some insight as to what may play out during the session in the US. A lot of times we might have futures prices that are down, but by the time the US market actually opens, that's seen as a buying opportunity. The rest of the world tends to follow the US, where the US kind of thinks for itself. There are times when China or something in Europe may influence the market, but it's usually not as big as you would think it would be. What I can do is bring up this page. It's investing.com. Doesn't cost anything to get to this information, but I can just get a big view of things while the US market is closed. I don't really follow the Dow and the S&P and the NASDAQ over here because I use other charts for that, and these only change when the US market is open. What I really follow is over on the right-hand side, this little box right here. The US 30 futures, that's the Dow. The US 500 futures, that's the S&P 500. My one complaint about this is there aren't any NASDAQ or NASDAQ 100 futures. They're very heavily traded too, but they're not represented on this chart. If I want to look at those, I have to go to a different place. What I follow a lot is the dollar index. There's a lot happening in the US right now with fiscal policy and monetary policy, and so keeping an eye on what is the dollar index doing is very important. The US dollar index compares the dollar in the US with all of the other currencies in the world. The main currency that it's compared with is the euro. As I scroll down, there are lots of different indexes that we can look at. There's the DAX in Germany, which I follow pretty closely. There's the FTSE in London, the CAC 40 in France. There's the Euro Stock 50, which is more of an EU index. You can go all the way down. There's Russia. There's Budapest. Don't really pay attention to those all that much. Way at the bottom are the Chinese indexes, and I keep an eye on those. Even though what's happening in China doesn't have that big of an impact on the US, sometimes it does. It just depends on whatever the markets are fixated on at any given time. I have it turned off, but there's also a video that plays nonstop, so you can get a little bit of market commentary. Some of you might find that helpful. I just find it annoying myself. There are times when I'll watch things, but most of the time I just want to see the numbers myself. If you have different tools, please let me know. what you follow. For a long time, I used Google Finance, but they've pretty much abandoned that. Yahoo Finance can be another really good tool to use. I just want something that has everything I need right on one page. That's why I've settled on this one. And it tells me what I need to know. I can glance at it even when I'm busy doing other things. I can have this on my phone. If I'm out and about, I can just look at this just to get a feeling for what's happening. And I cover more of how I observe the markets in a different video, and I really go into depth in this in the class that I teach. What can we conclude from this video? There are thousands of indexes that are available out there. Some of these indexes are helpful for providing insight. Some of them are very helpful, while others just duplicate what we already know. The same thing in a little bit different way. Still, others do not really give us much insight. Out of the thousands that are out there, I'm constantly looking for those that provide some kind of insight, but are also popular at the same time. Market participants find the indexes that end up becoming popular. That's what I tend to focus on. You may disagree with that. You want to find some secret holy grail index that gives you some insight that other people don't have? That's fine. Go ahead and use that. Indexes are used to create not only mutual funds or index funds, they're also used to create ETFs. So you're not investing in an index, you're just investing in a vehicle that's based on an index. The idea is that they have a one-to-one relationship. Now there are some ETFs and mutual funds that have an inverse relationship. If the index goes up, that mutual fund or ETF will go down. If that index goes down, that ETF or index fund will go up. The multitude of indexes used for insight by the SPX investing program is constantly changing. I'm always looking at these things. As I read things, as I go to webinars, as I study, I'm always looking for different indexes. Comparisons can be made to give you a big picture view, or you can also have a more narrowly focused view, whatever your investment style is.
This concludes Module 2, Section 6, and I'll pick up again in Section 7.